We are joined right now by Dominic Konstam. He is the head of interest rate strategy at Credit Suisse. Glad to have you with us in the studio, Dominic. Charitable this hour in the morning as well. Now, some say there's no way that the 10-year prices can keep rising and rising. You say there's 3 reasons why they have to.
Right. I mean, the most important thing is obviously having a reality check on the strength of the economic recovery.
And was that nailed down on Friday when you saw that jobs report?
Yeah, it was a very disappointing report, and I think the idea that you're going to have a very powerful V-shaped sort of recovery is obviously should be put off the table, and people should reappraise what kind of recovery it's going to be, and it's going to be a bit disappointing, we think.
You also say inflation will fall, and you say the Fed remains very divided on an exit strategy.
Right. The interesting thing is how much inflation falls, and we think it could fall a lot. And that kind of disinflation or even deflation fear is going to be an important part of bringing the long end down, so 10 years coming below 3%. And the third thing is really the Fed and the idea of how credible they're going to be, and this potential threat of withdrawing liquidity. And the idea is that if risk assets do well, the Fed is more likely to withdraw liquidity earlier, and that's actually also very good for the long end.
Before we talk about the likelihood or how bad the deflation, disinflation scenario can get, so could we see 2.5% then by year end? You said at least 3%.
Yeah, we're looking for the 10-year to trade in the 2.5% to 3% range by year end, exactly.
So what are the chances then, scale of 1 to 10, we go back to the 70s?
The 1970s in terms of...
Just disinflation, deflation.
I think the idea that over the 5 to 10 year view, there could be a big shift, I guess, in terms of the attitudes towards inflation, and you get tired of having a sort of stop-go on the economy. But a lot of things have to change, and it would include, for example, not having fiscal credibility. So the idea of eventually having to tighten fiscal policy is obviously very important, but that's not the battle we need to fight right now. We have to worry about the disinflation.
Dominic, I wanted to ask you briefly about that prediction of yours for Treasury yields. How low might we see an environment in which Treasury yields are between 2.5% and 3%? Because obviously they have spiked down in the past, but it didn't last that long.
Right. The reason why they haven't lasted long is because there's been a lot of risk premium that people have been putting in the back end related to the inflation down the road, because they look at the Fed's balance sheet and they can't figure out how does the Fed control inflation with that kind of balance sheet. And I think what the Fed has been doing is they've been demonstrating that they've got a lot more control over it than people think, and that there are these excess reserves in the system that they can either get rid of or lock down in some way using interest on reserves. So I think people are coming around to the view that the balance sheet isn't quite the problem for the long end that it might have been, and therefore if we're right on the economy and in falling inflation, I think that risk premium in the back end will come down.
Dominic, we hope you come back. Always glad to see you. Dominic Konstam there from Credit Suisse.